Welcome back to the Capital Mindset Show. I'm going to be going over Sleep Number and a little bit of a detail about Sleep Number. So this company is one that we did go over in a live stream. For those of you who watched that live stream, I'd love for you guys to comment down below about this live stream if you guys watched us go over this company live. But basically, this company was a company that Everything Money, they really liked. And so I guess because of that popularity, I was asked about it on the live stream. And one thing that surprised me was, given in the context, was this company had no debt, and that was what made it attractive. Okay, but one thing we did during that live stream was we just went over the company, and I will show you in just about 5 minutes how we can find out what the heck is wrong with this company and just how silly and probably uninformed those guys are at Everything Money, because when I saw this, I really got you could say I was already kind of critical of their practices, but got very disillusioned. But this is kind of going to be constructive for you guys who were wondering, well, why is this such a bad company? So on the surface, you see, well, a PE ratio of 9.63. Okay, it looks cheap there. Stock price is down, but at the time, the stock price was way higher. Okay, way higher. So keep that in mind. So the stock price when we were first asked about this was a lot higher. The stock price when they were looking at it was way higher as well, and when they were buying it was also way higher. Now the company, if we look at the 5-year, it's performed okay, up 36.32% in the 5-year, but it is far down from its highs of about 71.14%. Okay, and then from the lows of COVID, it is still up 166.95%. Now what the heck is going on? So we're going to do it basically live or through this recording. There's not going to be any pauses, and we're just going to go right here. We're going to go to their website. You're going to go to their investor relations, right? Pretty simple. You go here. No, go away. Investor relations. We're going to go to their SEC filings, right? So we go to financials, SEC filings. You're going to go to their most recent report, and then I want you to pull up, if you're following along, you can do this along with me. So go to their most recent report, the 10Q, and then you're going to go back here, and you're going to go to just the quarterly filings to kind of filtrate this. And let's go to a 2021 report. Okay, so 2021 report, and let's pick the last one in 2021. Okay, so this is the last one in 2021. Let's go to the balance sheet, and we're going to find that by going to the consolidated balance sheet. And then we're going to do the same thing here. We're going to go here, and you see how they even changed the format. This is interesting. I like this one a little bit better. I don't know about you guys, but it's the same thing. So here we have the two of them, and let's zoom in for you guys. So I'm going to put it over here, over yonder, and then I'm going to put myself kind of here so I'm not in the way. And then we have this one, and I'll also zoom in. So remember, this is the old one. Okay, so immediately what sticks out to me is, well, I already know the answer, but some of you who are newer to the channel, you guys don't know the answer to this. Or maybe you guys already do because you have some accounting experience or something. I don't know. But if you go through this, you see, okay, well, they have cash equivalents, 1.8, and I believe that is in millions, right? So 1.8, inventories, 86 million, prepaid expenses, all that jazz, right? You go down to the current liabilities, and boom, you should be hit with this borrowings under revolving credit facility of $359 million. Immediately, this is something to be put a star on that, okay? And then we go to the non-current liabilities. What you notice is that there's no long-term debt. So this is where the falsehood was stated by Everything Money to their audience. And I don't know, unfortunately, if some of them bought it based off of that information. This is exactly why also you should always do your own research. You can't entirely blame them for this because you should have done your own research. But at the same time, if you're learning from them and then you find out, there's not really much to learn from them, you get disillusioned after hopefully you find this out. But unfortunately, if you're finding out from me, maybe I don't know if it's too late. But anyways, so borrowing under revolving credit facility, this is a short-term loan, right? Issued by whatever lending institution that they're doing business with. I don't really care who they're doing business with, but the point is it's a short-term loan. And what's the problem with this? Well, let's go over some of the problems. Well, one, it's due in a year. That's why it's a current liability. It's due within 1 year. Remember that, due within 1 year. What do they have as current or total current liabilities? $890 million. This is the smell test. Okay, the smell test of a problem. Then they have total current assets, $195,327 million. And this is ending in in October 2021. Let's go back to the stock price. Let's go to October 2021. Okay, so had you been able to just read a balance sheet, you could have avoided this company because you would have seen this is absolutely garbage. This is a garbage company. This is a company that is in deep trouble. It is not well capitalized. They're either going to have to dilute the heck out of you, which we'll get to in a second because they did something very interesting. And then we'll go to the more recent one too, but let's focus on this. So had you done that in October, you would have probably avoided this company because you would have seen this is disgusting, the rate of current liabilities versus current assets, and they don't have a good current ratio. The current ratio is garbage, right? And current ratio is actually important, okay? Because that shows you in the near term, they're gonna have a bit of problem, okay? So again, they don't have any long-term debt. So if you were just going off of their research, you would see, okay, no debt whatsoever, no long-term debt, fantastic company, cash flow is great, blah, 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 blah. And I believe their cash flows might be okay, actually. So if we go to the statement of cash flows, we do see, yeah, cash flows are actually great. They're cash flow positive, but the cash flows are not nearly enough to cover the revolving credit facility. This is a bit of a problem because we do see, again, they owe in 1 year about $359.1 million unless they can re-extend it. Now, here's the problem. You might be thinking, if they keep pushing it back, what does that cause? What happens there? Oh, well, that probably means that they are, more affected by something called interest rates. Yes, interest rates. So if interest rates are rising, or if you're in a rising yield environment, what does that mean about them just pushing back that debt? Well, each time they do so, they're pushing it at higher and higher rates, which means what? It gets more and more expensive, okay? So they're getting a worse and worse and worse deal as time goes on if yields keep rising. So they were betting on yields kind of remaining the same. Now let's go over to today, okay? So the more recent one, July 2nd, 2022. So let's see what's happened. Ooh, it's gone up. Okay, so this is a big problem, and this is something I was telling Chris or Strongman Personal Finance specifically about this because I think we have our opinions about EM, and mine's a little bit more colored, I guess. But I just don't think this is probably just a good example of bad research, but I want it to be for you guys. So I'm going to stop talking about them. Enough about them. This is for you guys. So if you see a company like this, be careful with this because, long-term debt, sure, it's not there, but this is even worse. So they have all the debt in the short term, in the intermediate term. So they're rolling over that debt at higher and higher rates, and you see it right there. They're actually increasing, and they're borrowing under revolving credit facility, and cash is not improving. Hopefully, let's see if sales are improving. Or let's go to the statement of cash flows, right? Let's go here. There it is. So cash flows are getting worse. Getting worse. I wouldn't be touching this with a 10-foot pole because we went from cash flows from operations of 161.4 million to 28.6 million because go figure, the pandemic was a great time. So I don't know what this company was doing. Maybe management sold off during that run up, and you guys could probably do extra research there. That would be my little request to you guys if you guys want to do that extra research and find out what was management doing during this run up because they clearly were doing something, and I'll show you what exactly they were doing. So let's go to the evaluation tool here, and we go SNBR. And we're going to see exactly what they were doing and what it actually thinks about this company. So as soon as it goes, let's go. Okay, there it is. So analysts have a neutral rating with a price target of 71. So kind of ignore that. And let's go to the institutional rankings here. So it looks like neutral, overweight, underperform, neutral, outperform. Okay, Webush, I'm going to remember you now. So revenue is up and to the right. All right, revenue my avenue because you can totally pay shareholders revenue. Oh, look, shares outstanding. They cannibalized themselves, basically. So they brought down the shares by nearly half. So they cut the shares by nearly in half. And so, what were they investing in? That is very, very interesting. So they were grabbing a lot of money, and it seems like they were buying back stock, and they had all the short-term debt. What were they trying to do there? That's a good question. I think that's a good question to ask. What was management's capital allocation strategy there? I don't think that's very good capital allocation strategy. And one thing I just want to highlight is you can kind of see here that the model itself is not actually understanding whether or not this thing is going to go bankrupt. It's like, I don't know if it's going to last too long. So it's not certain it will go bankrupt, but it's not there. I'd probably be on if I was a betting man, I would probably say this company is going to go BK, or has a high probability of going BK if nothing changes. Something can change and then they can fix themselves, but I have a feeling it's a high probability of going BK. Okay, so with that being said, it looks cheap, but no, I wouldn't be touching this company with a 10-foot pole. And this is a case study. This will go down for, this video, will be forever. And it's another, added to the list of examples of value traps. And we'll do another video about a value trap coming up soon. I'll probably film it right after this one. And this one is a company I've already done videos on being a value trap, and it turned out to be correct, by the way. So we'll do that video as well. So with that being said, thank you guys so much for watching, and I will see you guys on the next one. Bye.